Hi, everybody. Dr. L here with another installment. In this segment, we're going to teach you pretty much all the basics you need to know about bonds in terms of how the contracts are structured, how they're described, and most importantly for our application, how you price them. So here's where we're coming from. Last segment, we finished our analysis by deriving the pricing formula for two really important core building block cases. First was known as the finite uniform annuity. And then we also did this for the case of a perpetuity, which we thought of as really the infinite limit of the finite annuity. And today in pricing bonds, we're going to see that a bond contract is really the sum of two different cash flows, or rather the cash flow structure of a bond contract is really the sum of two different cash flow streams, one of which is a finite uniform annuity stream. So we'll be able to use that finite annuity pricing formula on the second line here on this slide. The other cash flow stream associated with the bond is a one-time payment of what is known as the face or par value. And we are very experienced in being able to discount a single payment, so that shouldn't be a problem. So the agenda here, we're going to apply the annuity formula, the annuity pricing framework to help us price a bond contract. And to do this, the first thing we have to do is discuss the parameters of a standard bond contract. Next, we'll use the description of the bond to write out the cash flow stream associated with a particular bond contract. And then once we know the cash flow stream, life is pretty straightforward. We apply the classical theory to the cash flow stream, and we will be able to calculate the bond's price. Once we do that, we're going to take a look at the relationship between the interest rate, the yield on the bond, and the price. In fact, on a bond, the yield, the interest rate, when you purchase the bond has a very special name called the yield to maturity, and that's a key parameter that we're going to be concerned with here. Now, in terms of the description of a bond contract, we're going to go through the different parameters of the bond contract. The first one is something known as the face value or the par value of the bond. And for now, we're going to think about the par value as some chunk of money that you get paid at the very end of the maturity of the bond. Okay, so there's some chunk of money you get paid at the end. And then the bond also makes smaller payments each period called coupon payments. And these are often referred to as interest payments. Just to be clear, the coupon rate is a little bit different than the interest rate, but the coupon rate here is expressed as this constant C, which is typically a percentage of the face value. So the size of a coupon, the size of the interest payment you're going to get in any period, with the exception of the last period where you're also going to collect that face value F, okay, the size of those interest payments is going to be equal to the coupon rate C times the face value of the bond. Okay, and the coupon payments, they're going to start in period one, and we're going to assume they're made every period until the bond reaches maturity, which will happen in period T. In period T, we'll receive our last coupon, our last interest payment, and we will also receive that big spike of face value payment. Okay, second to last parameter we're going to talk about here is the current trading price, the current value of the bond, which we'll denote here with P with the subscript bond. And the relevant interest rate on the bond, known as the yield to maturity, is equal to Y. So the important parameters we need to describe the terms of a bond contract are these ones showing up in red: the face value, the coupon rate, the maturity horizon T, and we're going to see later that we could actually give you one of the two pieces of information, either the price of the bond or the yield. I don't need both of them, actually, just one of those two to be able to describe fully the terms of the bond contract. In some cases, you might get bonds that pay coupons, like let's say semi-annually, and usually coupon rates, that value C, as well as the yield to maturity Y, they are typically annualized rates. But if you had, let's say, coupons being paid, multiple coupons within a year, maybe monthly or quarterly, or let's say semi-annually, if you had two coupons being paid within a year, you would do the same thing that we had done with the APR when we were thinking about amortizing a home loan, in that you would just divide the coupon rate by the number of periods within the given year at which coupons are being paid. And you would do actually the same thing with the yield to maturity in that case. For the remainder of this lecture, I'm going to assume that one period is about 1 year, and there's one coupon being paid within a given period. So that coupon rate there is the entire coupon being paid in that period. Okay, now, if we were to consider the benefits flowing from the bond and we ignore the price we actually paid, then we're going to see here that the cash flow stream actually involves two important components. Okay, the first component is what we're going to see is really something very familiar. It's a uniform finite annuity flow of coupon payments, and the size of those payments are equal to CF, and we receive those payments in every single period, starting in period 1, ending in period T. The other part of the bond's cash flow structure is that there is a single face value payment being made only in period T, but otherwise, with respect to the face value portion of the cash flow stream, there are no other payments. Okay, so if we were to take those two streams, the coupon stream and the face value stream, and add them together, okay, then we would be looking at the entire cash flow stream in terms of the benefits received from owning the bond. Okay, so there's going to be T periods where we're getting a coupon of CF in every period. But note in the very last period, it differs a little bit. We get a slight spike where we get not only our last coupon, but we also collect the par value, the face value of the bond. Okay, so let's go ahead here and look at a numerical example. Let's consider pricing a bond, or rather, before we price it, we have to write out the cash flow stream. So we're going to start here with a bond that has the face value of $100, a coupon rate of 5%, and it's going to make payments for 3 periods. It's going to mature after 3 periods. Okay, the first thing you should note is that I haven't told you the price yet or the yield, and in fact, we do not need either of those in order to write out the cash flow stream associated with the bond's payments. Okay, so the cash flow stream does not depend on the yield or the price. However, we're going to see later both the price and the yield will absolutely depend on the structure of the bond's cash flow stream. Okay, so let's go ahead and write this out. The coupon rate is 5% of the face value. That means we're going to be receiving coupons of $5 in each periods 1, 2, and 3. The face value of the bond's $100, so the cash flow stream associated with that single face value payment across the 3 periods is $0 being paid in the first 2 and then receiving that par value at the end. So if we were to consider the total cash flow stream of the payments we would receive from owning this bond, we would be receiving 2 payments of $5, one in period 1, one in period 2. And then at the end, we collect our last coupon payment of $5, but we also add to it the face value of $100 for a $105 final period payment. Okay, now, given that we've written the cash flow structure of the bond, what we would like to do next is be able to figure out what is the market value price of that bond. And to do this, we're going to go ahead and apply the classical theory to the bond's cash flow stream and argue that the price of the bond itself should equal the sum of the present values from the coupon stream as well as the present value of the face value payment stream. So the argument we're making here is essentially the following, that if you were to take the price of the price of the bond itself has to reflect the value of all the payments that you collect from owning it. Okay, so we would take the present value of all those coupon payments, add that to the present value of that face value payment. And note here, I'm using Y as the variable to denote the interest rate. Okay, we could use R, but as we're going to see later, there's a difference between the prevailing interest rate R and the actual yield on a bond once time passes from the purchase point. But this is the idea. We're going to compute the present value of the entire cash flow stream from holding the bond. Okay, and we're also going to note that that coupon stream, that was a uniform annuity flow. So we could all the same, instead of calculating the present value of that coupon stream manually, right, we could just directly apply the pricing formula of the finite annuity stream to recover at least that component of the bond's price. Okay, so again, the term PV of the face value cash flow stream, that involves us discounting a single payment of F backwards, projecting it backwards by T periods. Okay, so from here, life should be fairly reasonable, right? We recognize what that present value is for the face value cash flow stream, and then we can go ahead and substitute in for the finite annuity flow, as well as for the present value of the cash flow stream. And if we had done it manually, right, we could have written out the whole cash flow stream, discounted all the payments, and it would look something like this. Okay, you'll note though, we could also exploit the structure of the uniform annuity flow. And rather than having to add up those T payments, we could use this one factor to replace it. So again, we're using that finite annuity formula, which allows us to simplify this term in the summation here, which involves us adding up T terms in a much more compact notation. Now you'll notice relative to the last video, I've replaced the value X with the coupons, CF, and I've replaced the interest rate with the value Y, the yield of the bond. But otherwise, that is the same pricing formula that we used for a uniform annuity flow, for a finite uniform annuity flow. Okay, note the term in blue here is the present value of the face value payment, which is just us discounting that face value back, capital T periods. Okay, so let's go ahead and revisit our example here. We had a face value of $100 on our coupon, on our bond, paying a 5% coupon across 3 periods. Let's suppose that the yield to maturity is 2%. And the question now is, what is the associated value of the bond's price? Okay, so we're going to utilize that yield, the value of Y, that's going to function like our interest rate for the bond. And to answer the question here, we're going to take the bond's cash flow structure, which we already characterized in the last example. And in the case of just these 3 payments, it is fairly manageable to be able to discount them individually and add them up without necessarily using the uniform annuity pricing formula, right? We can just add them up, discount them, and you would see here that the value of this particular cash flow stream, the value of these payments, comes out to $108.65 approximately. Okay. So what we would like to do here is, again, think about applying the pricing formula. So again, for that same bond valuation tactic, we could have thought about using that pricing formula we derived previously and implement the uniform annuity pricing. And if we did that here again, I'm just going to substitute our values of C, F, and T and Y into that pricing formula. And should be no surprise, we get exactly the same result, $108.65. Now, the second method here, using the pricing formula, this would be something you want to do if, let's say, you had a bond that was associated with making, over 100 payments, or maybe T was equal to 100. Okay, in that case, you wouldn't want to sit there on your calculator and adding up 100 payments. You would want to go ahead and exploit that uniform annuity structure of the coupon payment flow. Next thing I want to discuss has to do with the relationship between the price of the bond and the yield to maturity. And when we write out the pricing formula and we show the sum of those coupon payments explicitly, I think it's fairly easy to see how the changes in the yield would influence the price on the left-hand side, in that we note that the yield is showing up in the denominator of both expressions on the right. So if that denominator is getting bigger, okay, that is going to cause the price of the bond to get smaller, right? If the denominator of both of the expressions on the right is getting bigger, okay, both of those terms are getting bigger in the denominator, then that means both of the entire terms are getting smaller. Okay, and that's going to cause the price of the bond to drop. Okay. So similarly, decreases in the yield would drive the price in the other direction. Okay, if the yields went down, that means the denominators of those terms all get smaller, which would cause the price of the bond to get larger. So the important thing to see here is that the price of the bond and the yield are inversely related to each other. When one goes up, the other goes down, and vice versa. Okay, the other thing that I would like you to see about the yield of the bond is that it is actually the internal rate of return. If we thought about the bond as an investment where we had put some money in and then we get some money out. Okay, remember when we started our asset pricing unit rather, we got rid of that X0 payment because we argued it wouldn't make a tremendous amount of sense to receive a payment right away when you're paying for the asset. However, if we wanted to think about now the bond itself as an investment, again, where we have some cash inflow and we get some cash outflow, then we would treat the payment of the price, the purchase price of the bond, like an X0 payment, but it would be negative. Okay, so now we're writing out a slightly different cash flow stream. This isn't the cash flow stream of just the bond's payments. This is also including our initial investment cost. And if we wanted to compute the internal rate of return for this investment, how we do that? Well, we would take that cash flow, we calculate the net present value, we'd set it to 0, and then we would solve for the interest rate. Okay, so let's go ahead and do that. Let's compute the IRR by solving for the interest rate on that bond. So you'll notice I replaced R with the yield here. And if we were to do this, right, the price of the bond's already measured in present dollars. So the MPV formula just becomes the following. If our goal is to calculate that internal rate of return, then what we would want to do is use this equation here for our given values of the price, C, F, capital T, and we would want to solve for the interest rate Y. And so what we've actually shown here by doing this, by thinking about the internal rate of return of the bond's entire cash flow as an investment, including that outflow of the price, P with the subscript bond, what we can see here is that the yield to maturity is literally the internal rate of return of the bond's investment as a bond of the bond's cash flow stream as a full investment. So the IRR is the yield to maturity if you're thinking about the bond purchase as an investment here. From the initial perspective we've been taking, it seems that the yield on the bond determines the price, right? You give me the interest rate, I can discount the payments, I can get the price. And at the time you purchase the bond, the yield is absolutely the relevant interest rate used in pricing the bond's payments. However, once you own the bond and you start collecting payments and time passes, interest rates change. And the yield to maturity, which was the internal rate of return of the bond's full cash flow stream when you purchased it, that may no longer be the applicable interest rate in pricing the bond once things have changed. Right? Once you own the bond, prevailing interest rates may change, and whatever the going market rate of interest is should be the interest rate you use to discount the remaining bond payments if, for example, you intended to price them to resell them. Right? You collected a couple payments, maybe you need some cash, and you said, hey, let me resell the remaining payments on that bond contract. Okay, so again, the yield is the relevant interest rate when you buy the bond, but once you own the bond, the original yield to maturity doesn't matter anymore. It's whatever the going interest rate is that's prevailing in the market at which I could sell those remaining payments. That's the relevant interest rate to me. So let's go ahead and take a look at a situation where we consider selling a bond, and we'll stick with the one that we've been familiar with here. We have this bond, $100 par value, a coupon rate of 5%, making payments for 3 periods at a yield to maturity of 2%. And we showed here using the classical theory that in period 0, that bond is worth $108.65. Okay, now let's suppose we've bought this bond, some time has passed, and we've collected the first coupon payment, and it is now the end of period 1 after collecting that first coupon payment. And for now, let's assume that the interest rates remain constant, so that the original yield of 2% is still the interest rate. And that means then if we've already collected the first payment, then the remaining payments only involve a payment of $5 and then that remaining payment of $105. Now, once we've collected that first payment, something else has also happened. We've moved forward in time. And we're now standing in period 1, meaning those 2 future payments are closer to us. It looks like they're going to come sooner because we've actually moved closer to them. Okay, so the price of the bond's remaining cash flows, if we are in period 1 now, so I'm going to use a little 1 subscript above the price, okay, just involves us discounting the remaining 2 cash flows. And now the price of the bond after one period, after we've collected one of those payments, goes down to $105.82. And that should make sense, no pun intended there, because once we've collected the payment, the contract does not have as many cash flows in it anymore. Okay, so once we've collected that payment, the value of the remaining payments is lower because there aren't as many payments remaining to be collected if I were to sell it to somebody else. So let's go ahead and continue this thought by thinking about what would happen if we went ahead and we collected that second payment and then thought about maybe selling the bond. How much could we sell it for after 2 periods? Okay, we saw after 1 period, the price of the bond fell a little bit down to 105.82. So let's suppose now we've just collected our second coupon payment and we're at the end of period 2. We'll again keep the assumption that interest rates are constant. We'll play around with that in just a moment. And if we're in period 2 and we've collected now the first 2 payments, then the only remaining payment in the bond contract is that $105 payment, that last coupon in the face value. So again, we've now moved forward in time 2 periods. So that last payment is really only 1 period away from us now. And the question is, what is the price of the bond contract after 2 periods, at the end of 2 periods, given again that the interest rates remain constant at 2%, and we now only have 1 payment to collect. And we can see here, pretty easy calculation, that the price of the bond after 2 periods has now dropped to $102.94. And again, that should make sense. Okay, we've collected 2 payments of $5, which means the bond's value, which depends on the remaining payments, is going to be lower because there are fewer remaining payments. Now, let's suppose the interest rate had changed between periods 1 and 2. And we showed if the interest rate remained constant, the price of the bond in period 2 would fall to $102.94. And we could think about plotting, at least against time, how the price of the bond had changed at the interest rate of 2%. So these are the 3 different prices: the price in period 0, the price in period 1 after we collect the first coupon payment, and the price in period 2 after we collect the second coupon payment. Okay, but we're going to go ahead and think about what would happen if after we collected the first payment, interest rates had changed. So again, we started with the bond with the following parameters, and we want to now think about what would happen to the price of the bond in period 2 when the interest rate increases to 4% after we've collected our second coupon payment. Okay, what happens to the interest rate, what happens to the price of the bond in period 2 when the interest rate increases to 4% after we have collected that payment? So we're going to again be in this framework where we've just collected our second coupon payment, but now we're going to evaluate the cash flow stream at the new going market interest rate of 4%. So our original yield no longer applies. The interest rates had changed. And again, the remaining payment after collecting the first 2 is still that $105 payment. We're now taking, again, the perspective that we're standing in period 2. Right? So after just collecting that second payment, if the interest rates had changed between periods 2 and the end, okay, up to 4%, then this is going to cause the present value of the remaining payment to decrease. And as a consequence, the bond's price also drops down to $100. So we showed here that when the interest rate goes up, this causes a decrease in the present value of those future payments. And as a result, the bond's price falls relative to where it would have been, which is consistent with our assessment that there is an inverse relationship between the interest rates and the prices of the bond. They move in different directions, in opposite directions. So we showed the following. At a rate of 4%, okay, the price of the bond was smaller than what it was in the same period if the interest rate had remained at 2%. So relative to our diagram before, we can see here at a higher interest rate, we've now perturbed the trajectory of the bond price downwards a little bit in period 2. Okay, now what happens if the interest rate had gone up instead? Well, hopefully your intuition is telling you if the interest rate goes up, or rather if the interest rate goes down, and we considered an increase already from 2 to 4%, but now we're going to consider a drop in the interest rate. And if the interest rate goes down, that should cause the price of the bond instead to go up. So same exercise. We're standing at the end of period 2. And now the interest rates drop to 1%. So we've just collected our second coupon payment in period 2, and we want to evaluate the value of that single remaining $105 payment, but now using a lower interest rate of 1%. Okay, so if we do that at an interest rate of 1%, we do see, and it should match with our intuition, that the period 2 value of the bond at 1% is higher than what it was at both 2 and 4%. Okay, so what we've seen now is that when the interest rate drops, this increases the present value of the future payments, and it causes the bond's price to rise relative to where it would have been had the interest rate been higher. Okay, so now we can go back to our plot here, and we can plot the counterfactual price in period 2 had the interest rate instead been 1%, right? That pushes the price up relative to that blue trajectory. So we can see here when the interest rate stays constant, we wound up at this allocation, okay, at a price of $102.94. But if the interest rate increased to 4%, that pushed the price down to $100.96 in period 2. However, if the interest rate fell to 1%, this would have pushed the bond's remaining payments, at least the price of those remaining payments on the bond contract, the value of those up to $103.96. So we can see here 3 clearly different trajectories of what could happen to that bond price, right? The blue trajectory shows what happens if the interest rate remains constant at 2%. Okay, the orange trajectory shows what would happen if the interest rate had increased to 4%. And the green trajectory shows what would happen to the bond's price over time if the interest rate was to drop down to 1%. Okay, now you'll notice there were a few different interacting factors that could potentially affect how the price of those remaining payments changes. Right, when we consider the resale of the bond, a few things happen. Okay, we argued as we collected payments as they accrued, okay, then that meant there were fewer payments in the remaining contract's cash flow stream, and that effect alone caused the price of the bond to drop, and we could see that in our numerical example. Okay, the other thing that happened is we moved forward in time, okay, so that the remaining payments are actually sooner to arrive than they were in the past. When we were in period 1, the payments in period 2 were closer to us than when we were standing in period 0. Okay, the effect of us moving closer to the payments actually has the opposite effect in that they would increase the present value of the future cash flows. So effects 1 and 2, they work against each other. But there's a third effect. If interest rates change, and they typically will, if they go up, that puts downward pressure on the price. And if they go down, that puts upward pressure on the price. Remember, an inverse relationship between interest rates, yields, and the price of the bond itself. So whether or not the price of a bond goes up or down, if it appreciates or depreciates after you've bought it and you're holding it, really depends on how these 3 effects interact in terms of their relative sizes and directions. Do they offset each other? Do they reinforce each other? And so if you were thinking about, how can I make a profit by trading bonds, right? Well, remember, you can't really make a profit by just buying the bond because the classical theory utilizes a 0 profit, no arbitrage condition to derive the price. So if you want to profit from buying a bond contract, it pretty much requires, assuming the bond is originally priced competitively, that the interest rate environment changes. If you want to profit from buying a bond contract, taking a long position in the bonds, then you're gambling that the bond price is going to appreciate, and this requires 2 things. You need interest rates to go down after you purchase the bond contract, and you would need the effects of falling interest rates in 3 and the effect in 2, which work in the same direction, to more than offset the effect of collecting the payments in number 1. Okay, it's also possible to profit from taking a short position in bond contracts and selling bond contracts. Then you're gambling that the price of the bond is going to depreciate or decrease, and this requires that interest rates go up after you sell the after you purchase the bond contract, rather, or after you sell the bond contract, rather. And we would need the effect of the increased interest rates and the effect of one to work together in a way that offsets the effect of us being closer to those future payments. So you'll not be able to make a profit trading bonds unless the interest rates change. So when you're a bond trader, what you're really doing is you're gambling on the direction of interest rate movements. Okay, trading bonds is a way to gamble on what you think is going to happen to the interest rate in the future. Okay, now, while we're on the topic, I want to discuss fixed income securities. So bonds are a very specific type of fixed income security. And a fixed income security is an asset that at the time of purchase, you know what the full cash flow stream is that you are entitled to with certainty. And this is not true for many assets. For example, when you buy a stock, you do not know what the future dividends are. I don't know what that future cash flow stream is. But when I buy a bond, at the time I buy that bond in period zero, I'm told what the coupon rate is on the contract. I'm told what T is on the contract. I'm told what the yield is on the bond from the contract. So I know the entire cash flow stream of the bond. The only risk I really face is the risk of default and the risk of interest rates changing. And those can be hedged. So again, when you purchase the bond contract, you know exactly the parameters F, C, and T, which means you can write out the entire cash flow stream. The cash flow stream of a bond contract is deterministic. It's not random. Sometimes we would think about modeling, for example, a stock's cash flow stream as some sort of random process in that we don't know the future values of the dividend payments that would result from owning stock until time passes and we could observe those values. But with a fixed income security, you know what those future income payments are going to be at the moment you buy that contract that pays you them, which is why the contract is considered to be a fixed income contract. All right, now we're going to talk about a little weird idea here. It's a little bit of a chicken and egg problem related to the price of the bond and the yield of the bond. But again, given the values, the face value, the coupon rate, and the time to maturity, we could think critically about the pricing formula here. So I'm going to write it out in the summation form where it's a little bit easier, I think, to see the point I'm making. But for a given bond contract, F, C, and T, those are going to be fixed parameters. Okay, and if F, C, and T are fixed, the only variables that we could think about changing now are Y, the yield, and the price. Okay, so if we were going to go ahead and calculate the price of the bond given the yield to maturity, right? Then I could plug in the yield and I could compute the price. And this is typically what we've been doing, right? I give you the yield, you treat it like an interest rate, you discount the future payments, and that gives you the price. So that allows us to calculate P. Okay, however, if we were given the price instead, okay, so instead of giving you the yield and asking you for the price, imagine doing that backwards. I give you the price of the bond, and I ask you to figure out what is the yield to maturity. Okay, we could do this. I give you P. Now you can go ahead and use this equation to solve for Y. Okay, typically, you would need maybe a computer or a calculator to do this if it was more than, let's say, 2 periods where you could just have a quadratic expression and use the quadratic formula. But this can be done. So we're kind of in a weird situation where we're thinking about this chicken and egg problem. Which is it? Okay, which one is it? Are we thinking that it's the yield that determines prices, or is it that the prices determine the yields? Okay, we've argued it could be either. Okay, the answer to this question here is really both are happening simultaneously. You could think about bond prices in really 2 ways. I could tell you the trading price of the bond, and then you could plug that in and calculate the yield, or I could tell you the yield to maturity. You could plug that in, discount the payments, and calculate the price of the bond. Typically, if we report the price of the bond and not the yield on the bond, we usually express that as some percentage of the par value. The bond is trading at 80% of the face value, or 110% is trading above the par or face value. So again, given one of the two, right, either the price or the yield, you can always compute the other. Okay, sometimes you may hear on the radio or in the news, you'll hear analysts say bond prices were up today. The yield on the 10-year treasury fell. And hopefully we can think about why that's the case, right? There's an inverse relationship between bond prices and yields. I don't actually need to tell you both. If I tell you one, I've implicitly given you enough information to calculate the other. And in many cases, it's more convenient to refer to the bond price by reporting reporting the yields rather than actually reporting the purchase price itself. So we're going to think about the opposite route here, that the price actually determines the yields. And I would argue this is really what's going on conceptually. Okay, we thought we could plug in the price into our formula here, right, on the left-hand side, given fixed values of C, F, and T for a particular bond contract that we're looking at, and we could use this expression to go ahead and solve for Y. Okay, so the question of, where does the price come from? Okay, we're going to think of in the following vein of thought, right? Where does any price come from? Well, it comes from a market. Right? There's some market for the particular bond that you're interested in, a 5% coupon bond that matures in 3 periods. There's a market for that bond. Okay, and there's a supply of sellers trying to get rid of that type of cash flow stream. And there's a demand for buyers that want that type of cash flow stream. And if those supply curves and demand curves move around, that will affect the equilibrium price of the bond, which is the fair market price we are calculating using that classical theory. So P star in that diagram, that is the price of the bond. Okay, in the future, we're going to think about this idea of demand or supply changing. For example, maybe the Federal Reserve buys up a bunch of bonds. So it's now like there's an extra buyer in the market, right? And we know from our Econ 1, if we take an Econ 1, that more buyers in the market shifts the demand curve to the right and puts upward pressure on the price of the bond, okay, in the bonds market. That means the left-hand side of our pricing equation gets bigger from that shift in demand. And it shouldn't be a surprise here that when the Fed buys bonds this way, it drives interest rates down. And if you take macroeconomics, specifically, I think 110B, you should painstakingly go through this process of understanding how the Federal Reserve manipulates interest rates by essentially acting like a very big buyer in the bonds market. Okay, so chicken and egg, is it the interest rate that determines the price or vice versa? Conceptually, I think this is maybe a better story to tell here, right? People go into the market, they negotiate on what the price of the cash flow should be. That process pushes the market towards an equilibrium, which determines the price. We plug the price in, and then we can calculate what the yield is that is associated with the bond. Now, I mentioned we could report the yield as thinking about the price, or we could report the price, but typically this is done as a fraction of the face value. So again, if we thought about the bond's investment cash flow stream, where we paid the price in period 0, and then we received all these payments afterwards, we could think about dividing every element in that cash flow stream by the face value and rewriting a new cash flow stream, okay, where we've expressed now the price in period 0 as a fraction, as a percentage of the face value. And we can do this for any bond. We could take any bond's cash flow, we could divide it by its face value, and we could write it in this form. Now, why does this matter? Well, if we were trying to look at a cash flow stream and figure out, can I describe which type of bond it is, then this may matter to some extent, as you're going to see in the example I put together here. So let's consider the cash flow stream associated with the following bond investment. Okay, so we're looking at this cash flow stream, and it looks like we paid $90. We received a bunch of coupons of $5. And in the very last period, we get our last coupon of $5, and we get a face value of $100. So given that cash flow stream, it's not impossible for us to back out the parameters associated with this bond contract. Okay, the price is 90, the maturity horizon is 4. We collect payments for 4 periods. Coupon rate is 5% of that face value of $100. So if we wanted to, we could compute the yield here. We just calculate the internal rate of return of that payment stream, and that would give us the yield to maturity on the bond. Okay, so this bond contract, it requires us to invest $90 into this 5% coupon bond that matures in 4 periods. In order for us to generate these payments, right, I have to invest $90. So that cash flow stream represents an investment of $90 into this bond. But there's something weird to think about. Well, what happens if I invested a different amount into that bond? That it would surely generate a different cash flow stream, and that wouldn't be considered the same bond, would it? If we invested a different amount, does that mean we're buying a different bond? And the answer is no. Okay, so we're going to again consider this cash flow stream that we had looked at, right? We thought about that being one bond, price was 90, coupon rate was 5, maturity time was 4, face value was 100. But I'm going to argue here that bond B, the cash flow stream associated with bond investment B, is actually representing an investment in an identical bond. Okay, however, it represents a different scale of that investment, right? In cash flow stream B, we've invested exactly half as much. I put in $45 instead of 90, and you'll notice what we get back from that bond is also half as much to represent the scale of our initial investment. So I'm going to argue here that both of these bonds are actually identical. The only difference is in one case, we invested $90 into that 5% 4-year bond. And in the other case, we only invested $45 into that 5% 4-period bond. So when we invest half as much, it should make sense that the payment stream we're entitled to is going to be half as large. And so both cash flow streams A and B, they represent different size investments in the exact same bond, a 5% coupon bond that is maturing in 4 periods. So what really matters here, if it's not the absolute value of the price, what really matters? Well, I mentioned it before. It's the relative value of the price compared to the face value of the bond. Okay, so again, we have bond A, we have bond B. Heck, I'm going to even argue that bond C in this case represents an investment in the same bond, in a 5% coupon bond, okay, that is making payments for 4 periods. Again, what really matters when describing the type of bond is the coupon rate C and the maturity horizon T. Okay, once we know those two things, okay, we can always divide the bond's cash flow stream by the face value and express the price as a percentage of that face value. So if we did that for all 3 of those bonds, divide each of the cash flow streams by the face value. The face value in A is 100. The face value in B is 50. The face value in C is $10 because we invested a tenth. And then if we had done that in all 3 cases, we would get the equivalently scaled cash flow stream, which involves the price of the bond as measured relative to the face value at 90%. So here we would say the bond is trading at 90% of the par value. The price of the bond is below the par value. And we can do this for any bond. So if just because we're spending different amounts doesn't mean we're buying different bonds. We could just be making different sized investments in the same bond. So a couple concluding remarks. And we can express the price of a given bond contract for fixed values of C and T by either reporting the yield to maturity, right? If we know what that interest rate is, we can discount the payments, we can calculate the price, we can calculate that relative to face value. Or we could just report the percentage at which the bond is trading relative to face value, okay, relative to that par value, right? If the price of the bond's exactly equal to par value, then we say the bond is trading at par. And it turns out in this situation, you can show this analytically, the coupon rate and the interest rate, the yield on the bond, are actually the same if the bond is trading at par. However, if the bond is trading above par, that means the price of the bond is a little bit higher than what's implied by the face value, meaning you must have been collecting more coupons. Your coupon rate must have been higher than the actual yield on the bond. And in the last case, if the bond is trading below par value, then again, the price of the bond as a fraction of par would be less than 100%. And that means that the coupons are smaller in terms of percentage of face value relative to the yield on the bond. And again, you can use the pricing formula to verify all these facts, all these three facts. So that is the conclusion of our discussion on bond basics. Stay tuned for a few other shorter videos regarding applications to the yield curve, as well as equity valuation. Hope that was straightforward. Have a good one.